The major cloud providers are on track to spend over $1 trillion this year alone building out artificial intelligence data centers. But you can't just buy logic chips to run an AI model. Every advanced processor requires a highly specialized component called high bandwidth memory. Right now, this specific hardware is the absolute physical bottleneck for the entire global buildout. The major suppliers have completely sold out their production capacity well into 2026 and even 2027. This chart shows the performance of standard semiconductor stocks compared to pure-play memory makers over the last 12 months. While the broader sector saw modest 15% gains, companies directly manufacturing this memory jumped over 150%. Manufacturers have locked in guaranteed high-margin revenue for the near term, but that creates a precarious situation for individual investors. Buying into these companies today means paying for peak cyclical valuations, leaving a dangerously thin margin of safety if demand ever slows. Watching these numbers, a lot of people feel the pressure to get in quickly. Over $1 billion recently flowed into newly launched thematic funds, like the DRAM ETF, in days, promising an easy way to capture the upside. Institutional analysts, however, look at that same approach and see structural flaws. Their research indicates that piling into a thematic ETF right now might actually be the least efficient way to deploy your capital. This table highlights the core trade-off. On the left, you pay a premium for the convenience of a single ETF ticker. On the right, you take on the effort of building a targeted basket of individual memory and equipment stocks. So, do you absorb the extra fees and structural risks of an ETF for the sake of simplicity? Or do you take the time to build a targeted portfolio, engineered to survive the inevitable turn of the memory cycle? Let's look at what actually happens when you buy a thematic fund like the DRAM ETF. You are purchasing a pre-packaged product designed to give you immediate exposure to the global chip market. The obvious benefit is access. You instantly own shares in international companies without having to open specialized foreign brokerage accounts or navigate currency conversions. This quadrant chart maps these strategies by ease of execution against margin of safety. The ETF falls directly into the high-friction, low-safety zone. You are paying a 0.65% expense ratio for the privilege, and because the fund has to manage international exposure, it uses total return equity swaps, introducing complex counterparty risks. Worse, this structure spreads your capital thin. Despite holding multiple companies, roughly 73% of the entire fund is concentrated in just 3 dominant memory manufacturers. Ultimately, the ETF pathway asks you to pay an ongoing management fee and accept derivative risks, all to hold a concentrated handful of stocks that you could easily just buy on your own. The direct route means skipping the fund entirely and purchasing shares of the primary manufacturers, like Micron or SK Hynix. By buying the makers directly, you capture the entirety of their 70 to 80% gross margins on high bandwidth memory. There is no management fee dragging down your returns over time. But isolation brings intense concentration risk. When the industry brings massive new fabrication capacity online in 2027 and 2028, these currently inflated earnings multiples will compress rapidly. This bar chart compares forward price-to-earnings ratios. Micron trades at a premium multiple, while SK Hynix, despite holding a dominant 58% market share, trades at a forward PE of roughly 5 to 7. This valuation gap is known as the Korean discount. Taking advantage of that specific discount requires U.S. investors to endure a bit of friction. You either need to use an international trading platform to buy it directly, or wait for the company to list an American depository receipt. The direct approach gives you the absolute purest financial upside. However, it requires you to aggressively time the industry cycle and tolerate the friction of international trading. A third option is to ignore the chip makers entirely and invest in the foundational tool makers and inspectors, companies like Applied Materials, KLA, and Entegris. These suppliers don't care whether SK Hynix, Micron, or Samsung wins the memory market share war. Their revenue is secured strictly by the physical volume of new fabrication facilities being built and the increasing complexity of packaging the chips together. The trade-off here is momentum. These equipment stocks offer steadier, less explosive growth than the memory makers. Because their success is tethered to multi-year construction schedules, they demand much longer holding periods from investors. This strategy prioritizes infrastructure safety over artificial intelligence hype. You are putting capital behind the mechanical reality of a gold rush, rather than trying to guess which individual miner will strike it rich. Based on your constraint, for zero friction, avoid thematic ETFs and allocate into broader tech funds. For value, make SK Hynix your core buy, leveraging its 58% market share and Korean discount. For infrastructure, allocate to equipment suppliers like KLA and Applied Materials. There is no single perfect memory stock. The correct execution depends entirely on how you balance transaction friction, valuation, and infrastructure safety. Once you select a path, execution mechanics matter. Entering these positions requires staged, limit order entries, rather than buying at market price during today's peaks. By staging your entries, you mathematically protect your downside risk and preserve capital during macro pullbacks. You accept the risk of missing out on minor near-term momentum to ensure you don't overpay. This scorecard outlines the metrics for your exit strategy. You need rigid stop losses tied directly to industry-leading indicators, like rising inventory weeks, falling spot prices, and cuts to cloud provider capital expenditures. Pinning your exit to this data protects your portfolio from the notorious memory cycle crash. But you must actively monitor quarterly reports, instead of treating this as a passive buy-and-forget position. In a highly cyclical, hyper-bullish market, long-term survival relies on discipline. Success requires knowing the exact data metrics that signal when it is time to sell.